Brock Vandenberg, fund manager for TaliMar Income Fund and president of TaliMar Financial. Today, I wanted to discuss the headlines around the private credit industry and explain the difference between private credit and private real estate debt. While they may sound similar, they are fundamentally different types of investments with very different risk profiles. So let's go ahead and get started. Private credit typically refers to loans made to operating businesses. These are generally cash flow based loans, meaning repayment depends upon the performance of the business itself. If that business faces economic pressure, declining revenue, or operational challenges, the loan can become impaired. In many cases, these loans are unsecured or only lightly secured, which can make recovery more uncertain in the event of a default. Private debt, on the other hand, specifically around the context of real estate lending, is structured very differently. These loans are secured by tangible assets, specifically real estate. That means there is a recorded lien against a property with a measurable and supportable value. If a borrower defaults, the lender has the legal right to take control of the asset and recover capital through a sale, creating a fundamentally different risk profile. The key distinction comes down to collateral. Private credit relies primarily on the ongoing performance of a business, while private debt is backed by a hard asset. In a private debt structure, the investment is not dependent upon the company's future earnings, but instead is supported by underlying value of the real estate securing the loan. This is exactly where a mortgage fund fits. A mortgage fund is a private debt instrument because it originates and invests in loans that are secured by real estate. Each loan in the portfolio is backed by a recorded lien on a physical property, and underwriting is centered around the value of that asset, not the cash flow of an operating business. In the event of a default, the fund has a defined path to recovery through the underlying collateral. So when you hear headlines about stress in the private credit markets, it's important to understand what segment of the market is being referenced. Corporate lending challenges do not directly translate to asset-backed real estate lending. A mortgage fund operates within the private debt category with a structure designed around collateral protection, conservative leverage, and disciplined underwriting. For investors, that distinction is critical. A mortgage fund is not making unsecured business loans. It is participating in asset-backed lending with built-in downside protection. Understanding that difference allows investors to evaluate risk more accurately and make informed decisions, particularly in certain market conditions. TaliMar Financial has been operating for over 15 years. During that time, we've funded more than 1,000 loans totaling over $1 billion without any investor losses. We began our business during the Great Financial Crisis, providing capital to investors purchasing bank-owned properties and foreclosures. From there, we expanded our lending platform to include single-family, multifamily, and commercial properties, growing our investor base to over 50 million before launching our mortgage fund in late 2020. Since then, we've continued to scale, increasing our lending base to over 150 million. Throughout this time, we've operated through multiple periods of economic uncertainty, including the COVID-19 pandemic, the post-pandemic inflationary environment, the rapid rise in interest rates, and ongoing geopolitical instability. Across each of these cycles, we've maintained our core philosophy, originating first position loans secured by real estate assets in core markets. That focus has allowed us to navigate these periods successfully and, in many cases, capitalize on opportunities created by market dislocation. We are excited about the continued growth in our industry and the opportunity to further expand our platform. If you're interested in learning more about the mortgage fund, the performance of the fund, or the future direction of the platform, please don't hesitate to reach out. Thanks for taking a moment to watch.